What's going on, guys? Welcome back to another video. Today we're going to be going over my 401k account, what I am holding in there, and what my strategy is going forward. So as you can see on our screen here, I have a 401k plan with my employer Honeywell using the brokerage Fidelity. So most employers that offer this 401k plan, and with this plan is a retirement account that basically grows tax-free depending on what type of account you have. So with this account, you contribute post-tax money, which means you're paying taxes before you contribute, and because of that, your assets in your portfolio get to grow tax-free by the time you retire and withdraw your money. So with that being said, let's check out my portfolio. As you can see on my screen, I have $39,000, almost 40K in this account. And my rate of return for the 1 year is around 30%, which is pretty good. And we can see here, I started investing in this account around June of 2019. So roughly a year and a half of investing just passively, because every paycheck that comes in, it does allocate funds to this portfolio. So we do have steady increases, and that's mostly due to contributions. As I said, every 2 weeks, every paycheck, it does add more money into this account and spread across all of my allocated investments. But we can see, of course, I was affected by the March drop. I went from 15K all the way down to around 11K. But as we know, the market has recovered, and ever since it's been doing pretty well, especially over here. And the great thing about 401ks is most employers, they offer a company match, meaning they will match you up to a certain percent of money if you contribute. So that's free money on the table, and I am taking advantage of it. Every 8% I contribute, they will match 8% into my account as well. And as we can see on our screen here, of company contributions, I have accumulated almost $5,000, basically free money from the company due to the match. So the maximum you can contribute per year is around 19,000, and for the first year, I have been doing that, contributing the maximum you can. But I have since decreased it by half, so right now it's around $10,000 per year, of course spread out through all the paychecks that I accumulate throughout the year. And I'm doing that because I want a little more cash on hand for some more hands-on investments. I'm putting a little more money into my Robinhood brokerage account so I can basically trade options. I like doing a little more active trading, and that is how I'm going to be funding it. Eventually, I do want to buy a house, so I do want a little more cash on hand. And while I have reduced my contributions by 50%, 10K a year is still a good amount to be investing in. So let's get into my positions. The one thing that I would like to note is when you first start out with investing with your 401k, you are going to be automatically investing in a default target date fund. And what this is, it allocates a certain amount of percent into stocks and bonds based on your age. So the younger you are, it'll put a higher amount into stocks, pretty much almost all into stocks, and a small amount of bonds. But as you age and you get older, it will slowly shift from stocks to bonds. Now this is good if you don't know what you're doing, but with these target date funds, you could be selling and buying your assets at the wrong time, as well as high expense ratios are required for these funds because these are actively managed funds, and when there's actively managed assets moving from buying and selling, they're going to be charging you a hefty percent. So I do have some money in the target date fund just to see how it does. And when I started out, I initially did this until I learned more about other funds. So let's get into what else I have allocated my money to. First one being emerging markets equity. And what this is I'm investing in stocks from basically not developed countries such as China, Russia, India. And some of the main holdings in this fund would be Alibaba, Tencent, and Taiwan Semiconductors. So it's a pretty risky fund. It's high risk, high reward, but of course you could lose a lot because they are prone to fail if they don't do well. So we can see total gain and loss right on our screen. It's actually done pretty well. It's been 30% since I started, and yeah, I'm pretty satisfied with the results. I don't have a huge amount in there, as you can see, only around $550 into this this fund. The next one would be the Global REIT Fund. Basically, it's real estate, investing in real estate without owning any properties. So you invest into these companies that own tons of properties, rent it out to people. And the main thing about this fund, it's a great for dividends. So the price doesn't actually fluctuate that much, but in return, you do get some pretty hefty dividends. I think this one would be around 8% yield. So we can see only 10% gain. And so this is a little bit safer. It doesn't, like I said, doesn't fluctuate that much, but it does pay some good dividends if you want to have a little less risk in your portfolio. So next one would be the Growth Equity Fund. This is an aggressive fund and invests in growth stocks such as Apple, Facebook, Microsoft, Amazon, that sort of deal. And it's performed pretty good, up 26%. I do have a lot of money allocated into this fund because basically the younger you are, the more aggressive you want to be because time is on your hands. Next one would be international stock. It's similar to emerging markets, but it's not. But they are in developed countries. So you're investing in companies such as Toyota and Nestle. And this one has been and foreign stock like this is pretty high risk, high reward, just like emerging markets. But so far it's been doing pretty good, and I'm up 23% since I started. The next one is your classic S&P 500. Basically, you're investing in the top 500 companies, biggest companies in the U.S. So I do have a lot of funds allocated to this because it is pretty safe, and generally the U.S. market does pretty well. Up 22% on that so far. Next one would be the small to mid cap stock. This one has been my top performer. It's basically high risk, high reward. You're investing in these really small companies, hoping that they grow. And because they're so small, they have lots of room to grow, but they also have a high chance of going bankrupt. But so far, we can see it's been doing pretty good. So I do have a good amount of money in there. I have around 3,300 into here. Next one, of course, is the target date fund, which is default. I have most of my money here, 10.5k, but I am slowly reducing that. The expense ratios, all these funds have expense ratios, but this one has the highest because it is actively managed. So if you do your own research, I recommend moving out of target date funds. They're just subpar, but overall we are up 30%, so it's not a bad place to park your money, but there are better places if you want to be a little more proactive. Next one is a value / yield equity fund, which is investing in value stocks and basically stocks that have a good dividend yield. This includes Coca-Cola, Bank of America, Wells Fargo, basically your classic value stocks. They're going to maintain their value, pay you good dividends, and so far I have around $2,000 allocated to this fund. Now the last one is going to vary. So I'm working for Honeywell, so of course they're going to be offering the Honeywell stock as an option. So I do have a good amount of money in here, almost 8k, and so far it's been performing decent. It's not the best, but that's because most of the money that's coming in here is from the 401k match. So for every 8% I'm putting in, they're giving me 8% in Honeywell stock in return. That's my portfolio. 401ks, there's a lot of benefits, a lot of downsides. Obviously, the benefits is your money grows tax-free and you are dollar cost averaging into it, meaning you are continuously pumping in money into the account. You're buying the highs and the dips, and over time, it's going to average out. You're not trying to time the market. It's very passive. You don't have to look at this every day, and it's a very safe way to invest your money. Pretty stress-free. I don't check this account very often, but it's been performing pretty well. The downsides, of course, you have to wait until you retire. You can start withdrawing your money at the age of 59 and a half. If you withdraw the money early, you will have to pay taxes on your gains, as well as a hefty 10% penalty fee. So of course you don't want to do that. You're going to lose a lot of money. And if you do plan on basically using this money before you retire, you might want to consider a regular brokerage account. Some other downsides is you can't really choose what to invest in. They do have some pre-selected funds that you can only invest in, and that is because they're trying to get you to buy these funds which basically have higher than normal expense ratios, which help save the company money. It's not that good for you, but it is a higher than normal expense ratio. Overall, I think everyone should invest in a 401k, at least put in the minimum to get the match. And if you don't have a 401k, you can always open up a Roth IRA with any major brokerage, such as Vanguard, Fidelity, or TD Ameritrade. And basically, I think everyone should have a retirement account just as a safety net. Even if you don't think you're going to live until 60, it is great to have. Plus, you can pass it down to your kids, which is a great thing. So that's about it for this video. If this helped you or in any way, if it was informative, please hit that like button. And if you haven't already, hit that subscribe button for more videos. Thanks for watching.